Great. Thanks, Haley, and welcome, everyone. Going to jump right into it. So that's me, the Principal Analyst Telecom Practice at TDR, and my email address is there. If you want to email me, feel free, or add me on LinkedIn, too. That would be great. So before I jump into the predictions for this year, I just want to go over a little bit about the telecom practice at TDR and what we're researching. So we cover the global telecom industry and all the major things that are going on in it, including but not limited to 5G, edge computing, private networks. We do quite a bit of research on the hyperscalers. We've also introduced research on B2B revenue for telcos, and in the public sector domain, we have dedicated reports looking at opportunities for telcos to generate revenue from public sector opportunities. And then, of course, we have a variety of vendor and operator reports that look at a deep dive into each of those companies' businesses. So the predictions we're presenting today is based on research we've been doing in those areas, and looking forward, looking at the macro environment, coming up with three things that we think are going to be they're going to be fixtures of this year. So let's set the stage first, and then we'll get into the predictions. So we see a confluence of headwinds for CSPs in 2023, and there's knock-on effects that are going to come to the vendors as well. So it's really an industry phenomenon. So I've been doing this job for well over a decade now, and I've seen the LTE cycle go through. I saw other cycles go through in telecom. I saw the rise of OTT and some of these other trends. And what I can say from my standpoint is 2023 is likely to be one of the most uncertain and challenging periods for the telecom industry, maybe even in its history. The reason for that is there's a range of concurrent shocks that are going to impact. Can you guys hear me? Haley, can you hear me?
Yes. If somebody has lost audio, try refreshing your browser window.
Okay, yeah, I saw some Q&A. Yeah. Okay, but you can hear me fine.
Yes.
Okay. So the shocks are going to concurrently impact the industry this year. Telcos and cablecos are going to bear the brunt of this, and vendors are going to suffer knock-on effects. The challenges are large in magnitude, broad in scope, and they're occurring simultaneously. So those are big statements that we're making there. So I want to list out what these headwinds are, and we're going to talk about these things. So this is a list of the challenges that we see. Rising interest rates. I'm going to show data in later slides. Central banks of the world are shifting from quantitative easing to quantitative tightening. That is a major shift in policy. Ever since the global financial crisis in 2008-09, global central banks have been artificially suppressing interest rates for well over a decade now. And that has enabled companies and households and others to basically engorge themselves on debt at very low interest rates. And they use that money for things like share buybacks, dividend payouts, CapEx, all manner of things that money went towards. But now things are shifting, and we see a rapid rise in global interest rates that directly ties back to borrowing costs and the cost of servicing debt for companies and households. This is a consumer and a business problem that now has to be addressed. We're going to come back to interest rates later. Inflation. Inflation is very high, especially in developed markets. Ever since COVID, during the pandemic, governments created many tens of trillions of dollars for furlough programs, for economic stimulus plans, for Build Back Better programs, a whole host of different programs that money was in the public sector was generated for, and that money was pushed into the global economy. That unleashed an unprecedented wave of price increases and demand shocks and supply shocks. And inflation, the thing with inflation is it can become entrenched and sticky. The feds call it anchored. When it becomes unanchored, that's when it becomes a problem. And that's part of the reason why the Federal Reserve and other central banks are trying to raise rates faster, so that psychologically people don't come to expect inflation as a fixture of the economy. It helps them to combat it and bring the inflation rate down. But this is a problem because telcos, all other companies and households are facing inflation in various ways, and this is impacting margins, business decisions, etc. There's an insufficient 5G ROI. So so far, the telcos that have deployed 5G globally have spent a few $100 billion in spectrum and infrastructure to date. The majority of that has been in China and the States and places like South Korea and Japan. But the point I want to make is they're building it and the revenue's not coming. And this is a problem. We saw this happen with the 4G cycle, and we're seeing this happen again with the 5G cycle. The telcos built it and nobody came for them to make money. Other people came to make money, like the OTTs in the LTE cycle. But in the 5G cycle, we're not seeing the revenue coming. Yes, there's some very small pockets, maybe in South Korea, where there's a little bit of incremental ARPU increase. But in the grand scheme of things, it's not happening. There is one notable exception to that, and that is fixed wireless access, which is an economically feasible, ROI positive use case for 5G, and it works incredibly well. And we see a lot of demand for that technology. There is ROI with 5G FWA. However, if you look at the magnitude of investment relative to the magnitude of revenue that comes from FWA, there's a mismatch. So FWA is not going to save the telcos from making their ROI equation become more favorable. It's more of a fraction of the equation. So there needs to be more revenue sources that come from 5G. And as of right now, the industry can't find it. We don't know what it's going to be, what's the next killer app. It's unclear still. And we're about 3 or 4 years into the 5G cycle now, and there's still unknowns there. There's technological complexity. So Open RAN, virtual RAN, cloud native, network slicing, all of these big buzzwords. The reality is that this is incredibly complicated technology, especially when you have to stitch things together and do massive network overhauls across domains, breaking down silos, changing out systems that have been embedded for decades. This is big, heavy stuff, and it's expensive. And the telcos are really struggling with this. Yes, there's pockets of success here, but if you look at the industry level, if you look at the big picture, the industry is still really struggling with these things. Open RAN is not panning out. Virtual RAN is happening, but it's happening in a way that's not providing the full range of benefits that the industry is expecting. Cloud native is still a concept for telecom. These are things that need to happen for transformation in the industry and for cost structure transformation as well. We have energy costs. Yes, energy costs have come down a bit from when the conflict in the Russia-Ukraine situation started. Energy prices have come down since then, but they're still relatively high if you look at it over the last few years, if you look at the trend line. 5G is energy hungry, especially massive MIMO. And yes, there's been some incremental efficiency gains, and vendors are spending a lot of money on R&D, but the reality is, if you look at aggregate energy demand and you consider the rising data consumption of the world population, this is a massive problem. And that's not even considering supply chain issues of, can we even get the oil/coal/natural gas that we need when we need it at a reasonable price? This is becoming a big issue. And this is, from a telco perspective, this is impacting their margins because energy is one of the largest OpEx items on their P&L statements. Running those networks is energy intensive. Supply chain disruption. This is getting better, but if you consider geopolitics, if you consider the impact of sanctions, if you consider raw materials that are in short supply, things like rare earth metals, this becomes a problem. Can we get the infrastructure we need when we need it at a reasonable price? These are all things that are still a problem, especially on the chipset side. There is still pockets of problems with chips and certain types of components that go into infrastructure. There are still some shortages and backlogs that need to be addressed. There's new competitors. If you've been on other webinars of mine, we've talked about some of these competitors. Hyperscalers, what's going on in the private networks market. There's new entrants involved. Things are changing. This has a direct impact on telco and their vendors. Labor strikes, something that we haven't talked much about yet as an industry, but something that is simmering underneath the surface. There is significant pressure on wages to go up, and there is an expectation that unionized labor will get appropriate standard of living increases. If that does not happen, there's going to be strikes. And we already see that in Europe. Look at what's going on in the UK right now with the rail workers on strike, the nurses on strike. The NHS is basically breaking down because they can't get people to come to work because everybody's striking and they want a reasonable standard of living adjustment. So telcos, especially in Europe and in parts of the States, there are still unions that are relatively strong. And this is a problem. How does a telco operate? How do they navigate this? How do they make sure they have labor, skilled labor, to do the work that they need done? And how are they going to manage that in the face of inflation and business challenges elsewhere? These are things that are going to hit very hard this year. And last but not least, the recession, which hasn't happened yet, but it's coming. And we see it. We see slowdowns in the housing market. We see slowdowns in areas of the B2B sector. Trade, if you look at trade flows, they're slowing. There's a bunch of economic indicators that suggest that there is an economic slowdown coming. And that would have an impact on telcos and their customers and how their customers are buying services. Maybe they don't trade in their device. Maybe they wait. Maybe they trade down to prepaid from postpaid. Maybe they switch carriers that's lower cost. Maybe they do a reassessment of what they're buying and make sure that they're getting the value that they want. Those types of reassessments happen at scale, at broad scale, in recessionary environments. And we're starting to see those types of things happen in the industry. So this is just a list. This is not a comprehensive list by any means, but these are some of the larger things we see that are impacting the telecom industry. And the point I want to stress here is this is all happening at the same time. This is not like one thing's happening here and then maybe there's a couple things layered on and then you deal with that challenge and then you have another challenge. This is not whack-a-mole. This is happening simultaneously. And for that reason, we believe this is unprecedented in the industry's history. Okay, so with that backdrop, we're going to go into the three predictions, and they are the global telecom industry entering a rationalization phase. 2 is going to be looking at 5G infrastructure entering the post-peak phase. And 3rd is going to be a little bit about cablecos and what they're doing in the States, building out their own cellular networks. That's a trend that we're starting to see now. And for anybody that's interested in getting the full report this webinar is based off of, you can download this report. There's a link there, and there'll be materials that are emailed to you after this to download the full report. So there's much more data and content in that full report that this is based off of, this webinar. Okay, so prediction number 1, the global telecom industry is going to enter a rationalization phase. Now, this is already happening, but it's going to get kicked into high gear. And I want to paint the picture for what we see coming. Like this is simmering under the surface. These are things that there's been a lot of cans that have been kicked down the road over the years. A lot of things that have been problems that didn't have to be addressed. Things that now that we're moving from QE to QT, that fundamental change in the economy, these things are going to have to start being addressed. So we believe that telecom industry participants are going to be forced to make tough financial decisions to mitigate the headwinds that we just talked about. And we're expecting these outcomes to increase in frequency over the next few years. Specifically, M&A. We are expecting a wave of M&A to sweep over the telecom industry at a level that we have not seen before. There's talk in Europe just this week about reducing barriers cross-country among EU member states and dramatically reducing the barriers of trade flows in different sectors. Telecom was one of them. Now, it's being talked about. We'll see if it happens. But the reality is that there's a lot of telcos out there that are not financially strong, and there will need to be, something will have to happen with those assets, with those businesses, with those employees. There will have to be asset clearing and headcount clearing events and consolidation events happen to address that and to structurally alter the landscape. We're already seeing asset sales. Look at, I'm going to try not to name names, but there's some telcos in the States that recently did a big sell-offs, tier ones, that did some asset spin-offs. And in Europe, we're also seeing divestitures of European telcos that had bought assets in Africa and Southeast Asia. We're seeing them selling off those satellite, and when I say satellite, I mean the other countries that they have operations in, the OpCos. We're seeing those get sold off or different types of equity arrangements being put into place. The point is telcos are trying to raise money. That's really what's happening here. And by doing asset sales and restructurings of their assets, they're able to extract some value in different ways. We also saw this with tower sale leasebacks, where telcos were able to sell their tower assets and then lease them back from the tower company. And they were able to get an upfront capital infusion from that and then pay out on an OpEx basis for renting space on those towers. So we're seeing that now at a much broader scope. CapEx cuts. Just in the last 2 weeks, some telcos have announced CapEx cuts in various countries of the world. Philippines was most recent one I saw. There's others. Japan, there's going to be some reductions. In the States, we've already had some vendors announce that there's a slowdown, especially on the second half of this year. It's going to get much worse. This is multi-country, and we're going to see things roll off. Also in China, the vast majority of the 5G coverage deployment in China is complete now. So even there's a shift now from coverage to capacity. And as we know from prior RAN cycles, when you shift from coverage to capacity in your phasing, the CapEx load is less. CapEx comes down in the capacity stage. We're seeing share repurchase reductions. And we're going to see more of this where telcos were using excess free cash flow to buy back shares. We're already seeing situations where that's being scrapped or greatly reduced. Again, there is a tier one in the States that recently did this. And it was a fixed operator that did this. And they also made other moves that we're talking about on this list. Dividend cuts. We've seen 2 telcos now in the States cut dividends. One completely cut it, and the other one dropped it by about 40%. Those are significant moves because telcos will only cut the dividend, especially in the States. They will only cut the dividend if they are desperate for cash flow. Because as we've seen in the markets, whenever a company cuts the dividend, usually the stock takes a big hit. And that's exactly what happened in those situations. It's much easier for a telco to cut share repurchases and CapEx than it is to cut a dividend. So when you start to see dividend cuts, that's a symptom of a much larger problem. Recapitalizations. There have been a few telcos. I really don't want to name names, but there was one in the States, and there's been a few in Europe now in the last 2 to 3 months that have done equity offerings and senior debt offerings with heavy collateralization on those senior loans. So basically, in order for them to get the debt, they had to agree to restrictions, heavy restrictions on basically what they could do with that money. And they also had to put up collateral. Key assets went up for some of those collaterals. That was not happening just 2 years ago, where debt was called quote unquote covenant light, which means that you could issue debt at low interest rates and you didn't have to put on the restrictions and the covenants. Now we're seeing those things coming into the forefront again, which is a symptom of the shift from QE to QT. We're going to see bankruptcies. There was going to be one in India. There was a last-minute deal to do an equity transfer, and that has kicked the can down the road. But the point is, there are a bunch of telcos out there that if you look at their balance sheets, if you look at the P&L, and if you look at the cash flow, and if you consider the economic situation of their markets that they operate in, they have a structural problem with no clear solution. And that is going to create situations of the things that we're talking about here, especially M&A and asset sales. And of course, restructurings. Tier ones in the States, one of them has like a $3 billion, might be more now, they might have increased that, restructuring program in place, one of the tier ones in the States. But there's others as well. In Europe, several tier ones now have fairly significant restructuring programs that they've put into place. And again, these are symptoms of a broader issue. Okay, so I want to give some data here, and I want to talk about interest rates. So when we look at the environment for financing, the telecom industry has the leverage ratios in the industry are at very high levels historically. So this chart here is net debt to EBITDA. So basically, this is a way of measuring leverage. This is over the last 10 years. Last 15 years. And we have the leverage ratios for the tier one telcos and cablecos in the States. And I could do this chart for any telcos in any country, and you'd see a similar trend. And the trend is that leverage has gone up during the QE cycle. And that's fine because debt was interest rates were artificially suppressed by the central banks. That is now reverting back to a more normalized interest rates. So you have telcos out there with very high leverage ratios in the face of a weakening business environment, especially for their sector-specific headwinds. That is not a recipe for good things. That's a recipe for outcomes that are going to be very challenging. And so a couple of things to keep an eye out for. When the interest rates increase, which the Fed just increased 25 more basis points last week in the States, and Europe went 50 basis points, variable rate debt changes relatively soon. So any telco that is running revolving credit lines or variable rate floating debt, those rates revert to the new market rate relatively quickly. So there's a direct correlation between Fed interest rate hikes, and you'll see a little bit of a lag, and then you'll start to see the interest rate, expense on telco P&L statements start to increase. In fact, if you look at the tier 1 U.S. telcos, just as an example, some of their interest expenses have gone up by in the hundreds of millions of dollars in just the last year alone. That's money that they might not have even budgeted for in the face of the speed of the interest rates going up. So that's coming right out of their free cash flow, and it's crimping the margins. So that's something to keep an eye out for. Now, if we look at the U.S. alone for Fed interest rates, this is the federal funds rate over the last 25 years. And you can see the different recessions, the cycles. So the 2000 dot-com bubble, you see that cycle. You see the housing market subprime crisis, the great financial crisis in 2008. You see that cycle there. You also see the pre-pandemic tightening cycle, where there was a slight increase in the rate. Then they dropped it to zero during the pandemic. And now you can see the rapid increase coming out of that now that the Feds are trying to combat inflation. That increase in the span of the last year or so is historically unprecedented in world economic history. The speed with which central bank interest rates are increasing, in the timing, the speed with which it's happening, it's unprecedented. And it's catching a lot of entities in the industry off guard. Now they have to budget for this. Where are interest rates going to end up? What's the terminal rate going to be? After the blowout jobs report last week, which was far better than expected, and I'm talking about the States again, now they're talking about a terminal rate of 6%. They were talking about 5% before, just a few weeks ago. That extra percentage point on the Fed funds rate, if it does indeed have to go higher now, you're talking about significant increases in interest rate expense for telcos, and you're looking at other impacts, direct and indirect, on their businesses. So this is extremely significant for the industry, and the speed that it's happening is unprecedented. And we talked about it impacting operating cash flow, and telcos will have to respond to this. There will be responses to these macroeconomic challenges. We are expecting the CapEx environment to be lower this year, and we're expecting to see more dividend reassessments, and we're going to see share repurchases start to be scrapped in more frequency. Again, cutting share repurchases is one of the easiest things telcos can do, or any company, to raise capital quickly to improve their free cash flow situation. So the key takeaway, there is going to be forced decisions that need to be made to mitigate these macroeconomic and sector-specific headwinds. Okay, so we're going to move to the next prediction, and this one is about 5G. And the 5G market is entering post-peak phase. So what we have here is the global market size for CSP spend on 5G CapEx. This includes 5G RAN and 5G core, as well as capitalized services that are attached to this infrastructure, including deployment, maintenance, and professional services. So think of this as an all-in view of 5G infrastructure spend. For the RAN and core side, this does not include backhaul. It does include front haul. It does not include backhaul. So just to give you an idea of what we're seeing here. So we had a rapid increase from 2021 to 2022, and a lot of money got spent globally last year. China and the States led that. The vast majority of the increase stemmed from China and the States. We saw the C-band. We saw the CRS. There were some builds there. We've seen 2.5 build out in the States. And in China, you had a nationwide, very aggressive, broad deployment that was going on there. That was really driving the market. Now, the States and China are entering the post-peak cycle. So we talked about moving from coverage phase to capacity phase. Both of those countries are in that transition period right now. 2023 is the transition year. And what that means is that the CapEx that they're spending in those two countries is going to come down. And we're already starting to see that in the guidance for some of the tier ones in those markets. So it's going to be a slow come down, though. It's not going to be like an abrupt drop, like a steep drop. It's going to be more of a gradual trail off, okay? But the point is that we're shifting from rapid growth to shrinkage in the market size. This will be partly offset by India, where the 5G cycle is just ramping up now, this year, next year, and it's going to go into 2025. There's also a few other markets in Europe and other areas of the world where 5G is starting its big deployment cycle. But if you look at relative magnitude of spend at a global level, China and the States, they drive the global market. They spend so much in those two countries that it literally drives the entire market when they move. So, so the lead markets are past the coverage phase. So we said US, China, but it's also South Korea and Japan. They're in that bucket as well. We've got 5G. So the coverage is largely complete in those countries, and the shift is to densification. India, we talked about. Their spend level in India is a fraction of what the States or China would spend on an infrastructure cycle. So it's important. It should be considered. But from a global market standpoint, it's a partial offset to the reduction. Another thing we're seeing is many countries are sticking with LTE, especially for the mobile core, and they're going to be more gradual with 5G. So the vast majority of operators globally that have deployed 5G to date are doing NSA, which means they're tethering the 5G NR to an EPC. That is a limitation for the 5G market development. Over time, 5G core will be deployed, but it's been slow going there. And we're seeing telcos sweating their LTE assets as long as they can, keeping those in the field as long as they can and operationalized and leveraging those existing assets versus migration to new platforms, the 5G core being a new platform. And we talked about the unclear path to revenue, with the notable exception of FWA. This is a key reason why many telcos we see globally are going to take a more gradual, measured approach towards 5G RAN and core deployment. So the takeaway here is the vendors are entering a weaker sales environment from the last few years. The last few years were very good for the vendors. The next few years are going to be challenging for the vendors. Okay, so the last prediction, and then we're going to go into Q&A, is about cablecos. And we're specifically talking about the States because that's where we see a lot of MSO activity in the mobile domain. Cablecos entering mobile, that was something talked about for well over 10 years. And in just the last few years, they actually started to get into this market. And now what we're seeing is they're moving from the MVNO side to actual infrastructure ownership, running their own mobile networks and using MVNO as a complement to that. So this is a trend. The charts here, there's data here. What we're showing in the top right graph is revenue that the three big cablecos generate from mobile services in the States. So that's Comcast, Charter, and Antlitz. And you can see there that Comcast and Charter are growing rapidly from less than 500 million annual revenue as of 2017, 2018 timeframe. Now they've exceeded $3 billion each in revenue. That is, over the span of 5 or so years, that is extremely fast growth for the mobile sector. So they are taking market share from the traditional players in the States. And this is something we're tracking very closely across our reports. The pie chart on the bottom is market share. So yes, the cable guys are growing very quickly, but they only represent 2.2% of wireless market share. And we're calculating market share based on share of revenue in the U.S. wireless market. So it's a very small fraction of the total opportunity, but the cable guys are salivating over taking more market share there. And this is a big revenue boost to their businesses. As we know, the cable TV side of the business has been shrinking, and the high-speed internet side of their business has been flatlining. The mobile side is where they're actually getting growth from. So from a cable perspective, mobile has become front and center, a top priority. So we're going to talk a little bit about that. Because of the growth they've been experiencing, they've reached an inflection point where investment in their own network infrastructure becomes economically feasible. Comcast is the first one to do this. So they are going to be using 600 megahertz and CBRS spectrum for their cellular network. And I believe they're working with Samsung for that build. Charter has not announced officially that they're going to do their own network build out for cellular, but we are expecting them to follow closely in Comcast's footsteps. We are expecting Charter to announce its own network build sometime this year. We've also had other cablecos enter the mobile market in the States, Cox Communications being the most recent one with Cox Mobile. So this is a trend that is spreading to other cablecos in the States. This is becoming a very significant trend. Antlitz, as you can see with their revenue there, they haven't been growing. They've been kind of flat in the revenue. They've got some operational and strategic challenges to work through, but they are still a player in this market, and they should be taken seriously, especially if they are able to adjust their strategy and start to take some share. One of the things we're going to be looking for in the research this year is the pace of market share erosion. So how fast are subs migrating from incumbent telcos to cableco wireless plans? As we see, it's a fraction today, a small fraction, but we would expect the market share to be at least double what it is today within the next 2 or so years at the current rate of market share capture. So this is a very significant consideration, something that the incumbent telcos are tracking and seeing how fast is that shift over going to happen and how many people are actually going to move to the cableco plans. That's another consideration. Again, in the context of the landscape, the competitive environment, the recession that is impending, and how does that all shake out from a landscape perspective? So this is the cablecos have to be considered in that equation. The key takeaway is cablecos are going to be competing more broadly against telcos in the U.S. wireless market. We may also see cablecos in other countries do something similar, especially as they see the states' cablecos getting success. But as of today, this is predominantly a U.S.-centric story for this particular situation. And with that, we're going to open it up for Q&A. So I'm going to go right down the list. And if you have questions, just add them to the Q&A box, and I'll get through as many as I can in the next 15 minutes. So the first question is, so inflation is starting, it says with inflation generally starting to slow, energy prices coming down from where they were, and interest rates globally seemingly close to their apex, do you think 2023 might be less gloomy for the telecom industry than you initially projected when the special report this webinar is based on published a few months ago? Okay, so I do agree that inflation, energy costs, and the terminal rate of interest rates may be less bad than was forecast just 3 months ago. But with that said, the structural problems in the telecom industry ultimately will need to be addressed. So the leverage, the 5G ROI, the technological complexity, the new competitors, those are things that are going to have to be dealt with in some way, and it's going to need to be a broad response. So yes, unfortunately, it's a gloomy look for this year, especially this year, and it's probably going to be a multi-year cycle that this is for these things to work themselves through the system. But anything that gets delayed is just kicking the can down the road. There are structural, foundational challenges that the industry needs to figure out, and these are big picture things. Like, how do I actually make money from 5G? Like, those problems are not going to go away, and those types of problems have not gotten any less bad in the last 3 months since we published the special report. Okay, so the next question is, how does this impact private 5G? So we didn't talk about private networks on this call. The private networks market is actually a silver lining here. That market is growing. The growth is slowing according to our forecasting, but it's still going to grow at a double-digit rate this year. There is a vibrant ecosystem of vendors that supply the private networks market, and we are expecting good things out of that ecosystem. The problem is this webinar is about the telecom industry. Private cellular networks is, yes, it includes the telecom industry, but it's also beyond the telecom industry, because the whole point of private networks is for non-telco entities like an enterprise or a government agency to invest in their own network infrastructure and run and operate their own networks. So even though there's a market opportunity for that, from a telco perspective, the market's actually moving away from them because there's other mechanisms that those customers are sourcing their private network needs from, either direct from vendor or from a hyperscaler or from an SI. There's different conduits. You can now get private spectrum. there's shared spectrum bands, there's government provided industrial spectrum in places like Germany, where entities can go around the telco to buy their private network and get the spectrum they need and the infrastructure. So honestly, I think that the private networks opportunity is actually a net negative for the telcos, because it reduces their grip over the B2B relationship. It kind of impacts that in a negative way, and it empowers the enterprise and government to potentially source those solutions from other means and get the business outcomes that they're looking for. Okay, the next question is, are cablecos planning to use 4G or 5G to build out their own cellular networks? And what are their target use cases? MBV, FWA, question mark. So it's all of that. So 4G, 5G, ultimately 5G is going to be the most important. Everything's going to migrate to that. But you have to remember, they already have legacy subscribers that they have to support. Many of those are on LTE. So they're going to need to support both. From a use case perspective, they're doing FWA for markets where they want to overbuild. Maybe they have certain neighborhoods in a town with HFC plant, but they don't have adjacent neighborhoods with HFC plant. With FWA, you could splice fiber. You could run a base station at a telephone pole or something, and you could push a signal into that adjacent neighborhood, and all of a sudden you have reach to more households. So it unencumbers the cable co from the need to have fixed line at that last mile, and it enables them to greatly expand the number of households they could address. So it's for the FWA side, yes, check. And the MBV side, it's also a check mark, because they're going to be, they're providing smartphone, traditional subscription services for mobile broadband, and they're going to need to support that and the subscriber growth that they're forecasting to generate from that. The next question is, how fast is POTS replacement solutions growing, and how long do you expect this growth to last? So plain old telephone service is rapidly being decommissioned in various markets, in Europe and the States especially. There's still quite a bit of it out there. Replacement is happening, but once you start getting outside of certain markets, it becomes slower, or the pacing of the transition might be a little slower. So it's going to be a multi-year cycle to do a transfer over. The growth, I think it's going to last probably, the growth from the replacement solutions will probably be a little bit longer. But we have to remember that a lot of POTS has already been decommissioned, so that is to be considered as well. Like, a lot of that work has already happened in more of the major markets. All right, so any other questions? Add into the Q&A. I think that was the last one I saw in the queue. So here comes another one. On the topic of private 5G, we've seen RFX from telcos for private 5G. Do you see that based on your view of private 5G? Yeah, so RFPs from telcos. So my comments about private 5G are at a market level. So yes, telcos are winning private network deals. I didn't want to imply that they're not. But with that said, if they're capturing, say, hypothetically 25% of the total market opportunity, that is dramatically different than original expectations of the majority of the opportunity. And my point is that there are other mechanisms, other conduits, other vectors, if you will, for non-telco entities to source private networks and to build their own networks. And that's exactly what we're seeing happening. So in most cases, I'd say in more times than not, we're seeing enterprises going around the telco versus going through the telco for sourcing a PCM solution. So yeah, you'll see RFPs and you'll see more of them, but you have to think about it in the context of what's the total addressable market and how is that market actually behaving? Where is the bulk of the opportunity actually being realized? And what we're seeing based on our research is that opportunity is being realized from entities going around the telco. Okay, so the next question is, why are they going around telcos? So there's a few reasons. One is there's concerns about SLAs and liability. These are a big problem because if you're an enterprise and you're running business or mission critical workloads and you are relying on a third party, in this case a telco, to provide you with very stringent SLAs and maybe participate in liability in case there was a problem, right? Whose fault is it if there was a problem? That tends to break down the conversation. So there's that has to be considered. The second thing is there is a disconnect between the telco's understanding of their customers' pain points. So we're not talking about just, traditional MBB type services here. We're talking about autonomous robots. We're talking about safety helmets. Those types of devices that are being looped into these use cases for private networks. And the telcos need to invest in and get a better understanding of their customers' pain points that are industry specific or maybe even company specific. And they need to provide solutions that actually provide a business outcome in a way that enterprise wants to consume that solution. Could be as a service or another model, but it needs to be right-sized and it needs to be aligned with the pain points to address the needs. What we are seeing in the market is that enterprises are going to their SI partners, this consulting and systems integrators. They're going to them and they're looking for answers from those entities to solve these tough questions and to figure out how do we implement things like private networks, AI, and edge computing, among other new technologies, to transform our business operations. And how do we do that at the lowest risk and the most price-efficient way possible? And it's the SIs and the consultancies that are really driving a lot of the thought leadership and the traction in the market with those companies, as well as some vendors that are very proactive. There's a few vendors out there that are very proactive with their customers and that they invested in those resources to understand the very specific pain points and business challenges that those customers would have. So that's where we're seeing real success in the private cellular network space. So the next question is, which SIs and consultants are leading at this stage regarding FWA? So my comments were about private networks. For fixed wireless access, companies that supply that are Ericsson, Nokia, Samsung, companies like that. For private networks, the consultancies and the SIs to look at are companies like Deloitte, Capgemini, Accenture. Those are the companies, EY, KPMG, those are the companies that are really driving that with the customers on the private network side. Okay, I think that was the last question. So Haley, I think we can tie it up here.
Thanks, Chris, and thank you everyone for joining and for your questions. Please feel free to reach out to Chris with any follow-up questions. His email